welcome to another special episode of The Wealth Managers. Today I have with me Nimish Shah, Head Investment and Research at SBI Wealth. Nimish, pleasure having you on the show today.
Sure.
Thanks
Same
so
here.
much for taking
Thank
the
you.
time out. You know, you're the only PSU banking wealth manager that we've had in this series. Considering that SBI is the banker to every Indian, I must say you must have a phenomenal edge over the others.
Yeah, so it's a definite an advantage because we are the first ones in the PSU sector to really kind of come out with the wealth management option for our clients. It was actually a missing piece in the massive client base that SBI has, and to cater to the requirements of the HNIs who require special service in terms of both products and also in terms of the quality of service. Definitely, this was something which was missing, and this has been added. And like what you said, yes, the opportunity is huge, and that's where I think reaching out and being a wealth manager to most of the HNIs into India is what SBI is striving for.
Oh yeah, absolutely. So what is your current AUM? How did this journey start? I mean, how did SBI think that we're everywhere, we're the banker to every Indian, but we need to get into advisory, wealth management kind of roles as well?
So on the AUM front, we are doing pretty fine. We are currently in almost about 98 hubs across the country in about 26 major centers of SBI, and that pretty much gives us a wide coverage, including in the smaller cities. So that way we are more than about 35,000 clients onboarded and almost about 16,000 crores of AUM as we speak. Wow. But yeah, it's a long way for SBI to go, and the opportunity is among us.
Yeah, indeed it is.
Right.
So you have a close ear to the ground, considering you're already present in 26 cities. Tell me, where is the concentration of wealth, and are you really seeing emergence of the wealthy beyond the Mumbais and Delhis? Are you seeing tier 2 and tier 3 cities as well come to you for wealth management advice?
Yes, I think they are really open to the concept of wealth management, while a lot of other wealth managers are already present in these cities. But to the question of the wealth actually coming to the tier 2 cities is quite true. A lot of small businesses and a lot of medium scale enterprises are actually coming into money because of the efforts that they've made for so many years, and their businesses have come to a level where they are now able to monetize it, and therefore many people in these smaller towns also are actually coming into wealth because of sell-offs or because of the expansion of businesses which they are making.
So, I mean, we always all talk about it that only 5% or 0.5%, which was the case about 2 years back of India, is invested into financial instruments, and even lesser when it comes to equity markets. Considering you have that database of SBI with you, I guess, you would have that first mover advantage and you will be able to capitalize. Is the broader India open to equities as an asset class?
So on the SBI platform, our average profile of clients is slightly more on the higher side compared to the age profile is slightly higher compared to other the market players. But having said that, there is a requirement of getting market linked returns. So that awareness amongst clients is definitely setting in, and clients are open to look at equity as a portion of their total investments. So that awareness is creeping, and we are seeing that in the mutual fund numbers. We are seeing that in the importance which is being attached to the overall economic health of the country, and people are understanding these concepts much better than what probably they used to a few years back.
So how difficult is it really, when you talk about equity investments with your clients, given how volatile a time it's going to be from now up until the general election uncertainty gets over, both on the global front and domestic front, is it really difficult as to how to maneuver the markets and how to convince your clients that stay put with equities? After this volatility and this phase gets over, you will get back to seeing positive returns?
Yeah, so it's an interesting question, and definitely people are kind of edgy, if not kind of worried. So what we do is that we start first with risk profiling of the clients, and we also have every product which we are offering to clients as an option of investment which is risk rated. So matching of the risk rating of the client and that of the product is very important for us. Having said that, that's what we explain to the clients, that if you want to get into equity at whatever stage of the market it is, right, times will be volatile, and Volatility, I think, if kind of taken in the right way, can be a friend. But having said that, yes, we are seeing continuous flows, coming to the SIP book, and from that perspective, I think clients are understanding much more and are quite comfortable continuing, especially in the large cap segment. And it's more of a tactical call. So, for example, almost about close to a year back, we had given a tactical call to get out of small cap and mid cap to the extent of the profits that you have there. So that has proved kind of quite good with our clients, and clients appreciate those kind of tactical calls which come in. And I don't think they are really worried of getting out of equity as an asset class. But yes, definitely there are more questions than what they were a few months back.
And are they agnostic to any asset class? While you are, of course, pushing for large caps, all of us have had that feeling of 2017 when just about any mid and small cap that you touched turned to, the Midas touch, turned to gold. A tip in the lift also for small and mid caps would work. Do they really, wonder as to when those 2017 kind of returns going to come back, or is it a complete no-no for mid and small caps? It's not a complete exit, is it?
So no, we are not kind of recommending a complete exit. In fact, there are good opportunities available, specifically if the fund manager on the small and mid cap is good, and also stock specific recommendation on small and mid cap, given the correction which has already happened. But from the client perspective, yes, they are not all to kind of fall out for getting into small and mid cap, but I would say that if the asset allocation is right and you have fair amount of money is allocated to small and mid cap, then I don't think one needs to worry with a 3 to 4 year perspective. But if you want to get into equity at whatever stage, a minimum horizon should be 3 to 5 years. So that's what we tell clients, and not to get into equities with a horizon which is less than that.
View.
Yeah.
I'll come to the ideal asset allocation in a bit, but on the other asset classes, now very contrary views on whether or not gold should be looked at. Some believe that it's a great hedge, given the kind of volatility that the dollar as well has been seeing, given how precarious globally things are, what with the trade war, etc., etc. Do you believe that gold may be a minuscule part of your portfolio, but should be there in your portfolio?
So I would like to take this question more from the point of view of Indian perspective.
Sure.
The affinity for investing in gold is definitely kind of in the DNA of every Indian. So to that extent, it has proved kind of a fairly stable return giver as far as gold is concerned. And now with the government also providing the gold bond option, where in the dematerialized form you can have gold and you can also earn a small amount of interest. I think that does become a small part of an asset allocation of a client's portfolio, and given the fact that Indians will or may probably need gold from the point of view of future requirements in terms of weddings or in terms of gifting, definitely it is a kind of fairly large part of not large part, a fairly good part of investment of Indian investors after real estate and other asset classes as such. So we are not discounting gold. Are we bullish? It's very difficult to say, because there are two factors: international gold prices and the domestic rupee dollar depreciation or appreciation. So it all depends on that, but yes, minuscule allocation or a small allocation to gold with a longer term perspective definitely is on the cards.
So we've got Nimish Shah's views on what he feels about equities as an asset class, and gold he believes should be a minuscule investment. But what about debt? What about real estate? What should be the ideal asset allocation for both a conservative as well as aggressive investor? That's exactly what we're going to find out after this very short break. Still in conversation with Nimish Shah from SBI Wealth. We've chatted about equity as well as gold, but let's find out what to do with debt, because that seems to be really getting popular as an asset class, as an investment theme with investors. What about debt? Because, it's now again when you're seeing those WhatsApp forwards from your RM saying invest in fixed deposits for the next 1 to 2 years, because they're giving you anywhere between about 7 to about almost 8% returns as well.
Right.
And you know what? about 1 year back also, or even 6 months back, if you would have asked, do you put your money into fixed deposits? The answer would have been a clear no. So what exactly is happening in the debt market, and especially in the backdrop of the recent liquidity crisis, which of course has been managed very well by the government in the name of IL&FS? How should debt markets be looked at? Are liquid funds the only way to go, or do you think one could look at arbitrage or some other kind of tools as well?
See, I think fixed income markets or debt markets can be actually divided into two. One is in terms of the accrual, products, and second is in terms of the duration products. Duration products are something which can be as risky and as volatile as equity markets, and people who get into duration without understanding the risk attached to it will definitely need to face the, vagaries of the market, and we have seen that happen because of the, yields on the 10-year moving up to 8% and above, and then again because of the liquidity infusion and the support coming in from the government and RBI, these yields have kind of tapered down, and also because of the oil prices kind of moderating. So these ups and downs as far as yields on the government securities and therefore the fixed income markets and issues like NBFC liquidity, or because of credit rating issues definitely will crop up time to time. But as an investor, if you are understanding the difference between accrual and duration, then I think you can play the market well. And in fact, if you look at the accrual space right now, I think is the right time to actually look at something like a corporate bond fund or even like a credit risk fund, depending on your risk profile, to actually lock in for the next 2 years, 3 years, or even 5 years with a yield which is quite above what the fixed deposit can give you, and also giving you the tax benefit.
Okay, fair point. What about real estate? Is that a complete no-no? Gold is a minuscule part, but is realty anywhere as part of your asset allocation list?
So technically in asset allocation, we are not able to include real estate purely from the point of view that there is no benchmark available, and therefore there is no way where we can kind of predict the volatility and the returns of that particular asset class to give you a percentage allocation by throwing it into a model. Having said that,
but your clients, since you're present in across 26 cities, I'm sure must be having a large chunk of their portfolios in real estate.
Yes, they do, and to that extent, the queries on real estate definitely are very difficult to answer, because it's a market which is very micro-oriented, and even for example in Mumbai, it's very difficult to predict or even to tell in terms of what the individual micro market is behaving like. So we would rather leave that decision to the local advisors on real estate. What we also kind of look at is the mezzanine debt opportunities which are available in real estate for good quality borrowers. So that's something which on a fund platform investors can look into, and therefore getting a net of tax and net of cost return of around 10 to 12% is something which investors can look at in real estate rather than investing directly into real estate as such.
So if in this kind of a market environment you had to advise someone as to where to put in that fresh 100 rupees, both for a conservative as well as an aggressive investor, how would you allocate that across asset classes?
Right, so this is the time when a lot of investors would want to be conservative, but having said that, for conservative investors on the equity side, we would say that you should still be allocating almost about 25%, and that 25% should be broken up between probably a larger amount into large caps and a smaller amount into small and mid caps. And equity definitely, with a longer term perspective, will give you at least 3 to 5% more return than what fixed income will give you, and that's a huge addition to your returns as such. So we are continuing with that, and as far as aggressive investors are concerned, we should still continue investing at least about 60 to 65% into equity, but again with a staggered investment with at least next 6 months in horizon, given the facts we talked about, elections, and also in terms of the macro global headwinds. We feel that staggering it over the next 6 months would be a better idea as far as investments into equity is concerned.
Okay, that's the equity bit. Where does the rest of the 100 rupee go?
So fixed income, I don't think one needs to time the market, and as we have talked earlier, investments into accrual funds definitely can be done lump sum right now. Fixed maturity plans are also offering good options, both from the point of view of a coupon and also from the point of view of tax benefit with a 3 indexations or 4 indexations benefit, and therefore getting a net of tax return which is north of 7.5%. I think it makes a good investment proposition in fixed income at this point of time. gold probably about 5%. And for aggressive investors, we could also look at getting into alternative investments. So there could be options like real estate, mezzanine debt funds, or even in terms of looking at long short funds on the equity side, which can give them returns which are better than debt or probably slightly lower than equity.
So you're saying for the conservative investor, 25% equities, 5% gold, rest 70%, all of it into debt?
That's right. That's
Okay,
right.
great. What about SIPs? Like you're saying that SIPs are still continuing to flow in. We're continuing to see inflows come in. If you had to chalk out a list for a conservative and an aggressive guy to park some money into SIPs for, say, the next 2 years, I'm stretching the time frame here, so you're done with the uncertainty in the next 1 year, what would be the ideal mutual fund list from your stable?
So on the SBI platform, we are open architecture system, and we have almost about 19 AMCs that we have onboarded.
Yes.
So having said that, the list would all depend in terms of what the ranking and the rating we have for each and every scheme. While I would not want to recommend specific schemes, but of that, almost about of the 25% for conservative investors, about 15 to 20% should go into large cap and large and mid cap funds, and good quality, stable fund houses like SBI or even ICICI, Birla, Franklin Templeton. All of them, I think, are doing a wonderful job on that front, and we should continue kind of looking at investments into large cap from that perspective. Mid and small cap, I would be more choosy, and there we would want to pick fund managers who have the expertise, and also from the point of view of longevity in managing those kind of funds with a long historical background that we can actually look at, both from the point of view of volatility and returns, and our selection would be based largely on that. So I would be choosy on mid and small cap fund managers.
Where would you think that the disruption would be in the industry? When you talk about alternate investments, some people believe that that's where the big disruption is. The kind of funds, the niche that you can present as a wealth manager is what's going to differentiate you from A to B or to C.
Right.
So tell me a little bit more about the instruments or the alternative funds, the niche that you bring about at SBI as opposed to any other.
So currently we are catering more towards the average HNI, and our offering is more where the age group and also the risk profile is more like moderate, and from that perspective we are going slow on alternatives given the uncertainty in the markets also. But having said that, we are open to bonds also. For example, there are a lot of bonds which are giving you good return. We have bonds like, for example, NHI coming up in the near future, which will give you a fairly decent return if you are kind of holding on for 3 to 5 years. You have other options as far as mutual funds on fixed income is concerned. On the alternate space, you have portfolio management schemes. I'm kind of making them as alternate purely from the point of view the concentration risk that they carry. So there are good quality portfolio managers available in the country, and if you are having a theme in mind, or if you are okay with investing in just about 15 to 20 stocks, then these fund managers are doing an excellent job. So that would be one option. Mezzanine debt funds, like what we have mentioned, giving you about 10 to 12% net of tax and net of cost returns, is the other alternative which investors are looking at. And finding niche products for the sake of it in these markets is not advisable, because it's very easy to get into a fund on an alternate side which has a very, very long lock-in. But that's where the problem starts. So a lock-in of 3 years or 4 years is fine, but a 5-year or a 7-year lock-in is something where investors still are not very comfortable getting into.
Yeah, absolutely. What would you say is the biggest risk right now that the market hasn't foreseen? Because just about anything that could go wrong has gone wrong, right? Emerging market currency volatility. For us, it's the election outcome, which is looming large. Globally as well, we've seen crude go all over the place, from 80 to where people were predicting it's going to go to 100. It's back at 65 now. The trade war tensions, which now seem to have eased off. What's that one trigger that the market is not prepared for? And to add to that, our own NBFC crisis.
So I think you've mentioned most of the issues which have been kind of addressed to quite a certain extent as far as the volatility in the market is kind of taken there. So I think one issue is more in terms of the continuation of the earnings. So that is something which I think on the equity side will be looming large, going forward. And if there is the economic turnaround, which is expected to happen and which is kind of, at grassroots level it has started happening, if that falters for any reason, either because of elections or because of monsoons, the next monsoons, or purely from the point of view of any global uncertainty, say on the side of Europe, or if US slows down considerably in the next 1 or 2 years, which it may, then definitely these are the concerns which are there. But having said that, I don't think India is going anyway away from a 7% to 7.5% GDP growth for the next 2 to 3 years. And if you add inflation to that, real growth of about 11 to 12% is definitely on the cards. And if you're investing in good quality companies, whether in the fixed income side or equity side, getting at least that much return is quite sure for that's what I can kind of visualize going forward. And from that perspective, I would rather be positive on the markets and invest kind of in a staggered manner than postpone the investment and wait.
Okay, on that positive note, Nimish, great having you on the show. Thank you so much for
Thank you so
joining
much.
in.